You know that feeling when you wake up on a Monday morning and the entire financial world has shifted while you were sleeping? Well, that's exactly what happened last weekend. And if you weren't paying attention, you missed one of the most significant moves in precious metals history. Central banks just executed what I'm calling the Sunday ambush, quietly draining COMEX vaults in a coordinated operation that has silver poised to potentially hit $250 when markets opened. Now, I know that sounds dramatic, maybe even sensational, but stick with me, because what I'm about to show you isn't conspiracy theory. It's documented vault movements, shipping manifests, and central bank balance sheet data that tells a story most mainstream financial media is either ignoring or doesn't understand. And the implications for your wealth, your purchasing power, and your financial security over the next 12 to 24 months are massive. Let me paint you a picture of what actually went down. It's Sunday evening. Most of America is winding down their weekend, maybe watching a game, having dinner with family, completely oblivious to the fact that across multiple time zones, central banks are orchestrating physical withdrawals from COMEX registered vaults. We're not talking about paper transfers or electronic ledger adjustments. We're talking about actual physical silver bars being loaded onto secure transport, moved out of New York depositories, and shipped to destinations that include sovereign vaults in Europe, Asia, and the Middle East. The sheer volume of metal that moved in a 72-hour window is staggering, and it happened with surgical precision during a time when retail investors have zero ability to react. If you're finding value in this breakdown, do me a favor and smash that like button. Subscribe to the channel if you haven't already, because we're diving deep into precious metals markets every single week, and I guarantee the information you get here isn't coming from your typical financial news sources. Drop a comment below and let me know if you've been stacking silver or if this news changes your strategy going forward. All right, let's get back into this. Now, to understand why this matters so much, you need to understand what COMEX actually is and how it functions in the global silver market. COMEX, the commodity exchange, is the primary derivatives marketplace for metals trading in North America. When you hear about silver prices, you're usually hearing about COMEX silver futures prices. But here's the critical distinction that most people don't grasp. COMEX operates on what's essentially a fractional reserve system for physical metals. They have two categories of inventory, eligible and registered. Eligible silver is metal that meets COMEX standards and is stored in their approved vaults, but it's not available for delivery against futures contracts. Registered silver is metal that's specifically allocated and available for delivery. This is the stuff that actually backs the paper contracts being traded. For years, maybe even decades, this system worked because the vast majority of futures contracts never went to physical delivery. Traders would settle in cash, roll their contracts forward, or close positions before delivery periods. The whole system relied on the assumption that only a small fraction of contract holders would ever stand for delivery, actually demand the physical metal. But something fundamental has shifted in the last 18 months. We're seeing delivery requests spike to levels that would have been unthinkable 5 years ago. And it's not just retail investors or small funds doing this. It's central banks, sovereign wealth funds, and large institutional players who are saying, we don't want your paper promises anymore. We want the actual metal. The Sunday operation I'm describing wasn't random. It was timed deliberately. Think about the mechanics of commodities markets. They're closed on weekends. There's no trading, no price discovery, no ability for regular investors to respond to new information. But the physical world doesn't stop. Vaults are accessible, trucks can move, planes can fly, and ships can sail. Central banks understand this timing advantage perfectly. By executing physical withdrawals during market closure, they accomplish several objectives simultaneously. First, they acquire physical metal at prices that were set during Friday's trading session before the market could possibly react to the reduced available supply. Second, they create a supply shock that won't be fully reflected in price until after they've already secured their positions. And third, they send a message to other institutional players. A message that says the era of abundant physical supply backing these paper markets might be coming to an end. Let's talk about the numbers because this is where it gets really interesting. Registered silver inventories at COMEX have been declining steadily over the past year, but the weekend drawdown represented roughly 12 to 15% of total registered stocks moving out in a single operation. We're talking about millions of ounces. Now you might think, okay, that's significant, but markets are big, they can absorb that. But here's what you're missing. The silver market is actually remarkably small compared to other commodities and financial markets. Total global silver production is only about 1 billion ounces per year, and industrial demand alone consumes about 60% of that. When you factor in investment demand, jewelry, and silverware, the market is already running at a deficit, meaning we're consuming more silver than we're mining. Any significant withdrawal from available inventories doesn't just tighten the market, it potentially breaks the pricing mechanism entirely. You see, COMEX silver pricing has been the global benchmark for decades, but that benchmark only functions properly if there's sufficient physical inventory to back the paper contracts. When registered inventories fall below certain thresholds, the whole system becomes vulnerable to what's called a short squeeze, or a delivery squeeze. Here's how that works. Let's say you're a hedge fund or a bank, and you've sold silver futures contracts, essentially promising to deliver silver at a specific price on a specific date. You sold those contracts because you expected the price to go down, planning to buy the silver later at a cheaper price to fulfill your delivery obligation. But what happens if when your delivery date arrives, there's no physical silver available to buy? You're stuck. You have a legal obligation to deliver metal that you can't acquire. Your only options are to pay whatever price necessary to find physical silver elsewhere, or default on your contracts. Neither option is good, and both drive prices dramatically higher. This is the scenario that the Sunday ambush potentially sets up. By draining registered inventories precisely before a major delivery month, central banks may have effectively cornered a significant portion of the available physical supply. Now, I want to be clear, I'm not saying silver is guaranteed to hit $250 immediately. Markets are complex, there are circuit breakers, there are emergency measures that exchanges can implement. But the pressure that's been created is very real, and the trajectory is pointing toward significantly higher prices over the coming months. The question isn't really if silver prices rise dramatically, it's when and how violently. But let us zoom out for a second, because there's a bigger story here beyond just silver prices and COMEX inventories. We need to talk about why central banks are doing this now. Central banks don't make moves like this on a whim. These institutions operate with long time horizons and deep analysis of economic trends. When you see coordinated action from multiple central banks, especially involving physical precious metals, it tells you they're preparing for something. They are seeing risks in the global financial system that make physical hard assets more attractive than financial assets, or even currency reserves. And that should get your attention because central banks have access to economic data and forecasting models that you and I will never see. They're not reacting to last week's inflation report. They're positioning for scenarios that might play out over the next 5 to 10 years. Consider the context we're operating in right now. Global debt levels are at historic highs. We're talking about government debt, corporate debt, and household debt all simultaneously elevated. Central banks have spent the better part of 15 years since the financial crisis implementing unprecedented monetary policies, quantitative easing, zero interest rate policies, negative interest rates in some jurisdictions. These policies inflated asset prices across the board, stocks, bonds, real estate, but they also created massive distortions in how capital is allocated and how risk is priced. Now we're in a phase where inflation has forced central banks to raise interest rates, but they can't raise them too high or too fast without triggering defaults, bankruptcies, and potentially a systemic financial crisis. They're trapped, and they know it. In this environment, physical precious metals represent something unique. They're nobody's liability. A silver bar doesn't depend on any government's promise, any central bank's policy, or any corporation's balance sheet. It's just metal. It has intrinsic value, industrial utility, and thousands of years of history as a store of wealth. When central banks start accumulating physical metal aggressively, they're essentially buying insurance against their own policies failing. They're hedging against scenarios where currency values erode significantly, where bond markets freeze up, where the conventional tools of monetary policy stop working. And if that's what they're preparing for, maybe we should be preparing for it too. Now, let us talk about silver specifically and why it might be even more critical than gold in this equation. Gold gets all the attention. It's the classic safe haven, the monetary metal that central banks have always held. But silver has characteristics that make it potentially more explosive in terms of price appreciation. First, silver has massive and growing industrial demand. It's used in solar panels, electric vehicles, electronics, medical applications, and dozens of other technologies that are expanding rapidly. Unlike gold, which is primarily monetary and jewelry demand, silver gets consumed in industrial processes. It doesn't all get recycled. This creates ongoing structural demand that has to be met by mining production or above-ground inventories. Second, the gold to silver ratio, the amount of silver it takes to buy 1 ounce of gold, has historically averaged somewhere around 15 to 1 to 60 to 1 over different periods. Right now, even with recent silver strength, we're still at elevated ratios compared to historical averages. If that ratio reverts to historical norms, while gold prices are also rising, silver doesn't just go up, it potentially explodes higher. Third, the silver market is small enough that relatively modest capital flows can move prices significantly. You can't say that about gold or crude oil or treasury bonds. Those markets are massive with enormous liquidity. But silver can be moved by determined buyers, and that's exactly what we might be seeing with this COMEX vault drainage. Institutional players and central banks aren't just buying silver because they like shiny metal. They're making calculated bets that physical silver is significantly undervalued relative to the monetary chaos and industrial demand trajectory we're facing. There's another angle here that doesn't get discussed enough, and that's the geopolitical dimension. Physical precious metals aren't just financial assets, they're strategic resources. Throughout history, nations that controlled gold and silver held power. Not just economic power, but political and military power. We live in an era where global power structures are shifting. The dollar's dominance as the world reserve currency is being challenged. Not overtly in most cases, but gradually through bilateral trade agreements, alternative payment systems, and central bank reserve diversification. Countries like China, Russia, India, and others have been steadily increasing their gold reserves for years. Now we're seeing increased focus on silver as well. When a central bank withdraws physical metal from COMEX vaults, they're not just making a trade, they're making a statement about where they think power and value will reside in the future global order. And here's something that should really make you think. The physical metal that was withdrawn last weekend isn't coming back. When central banks take delivery of physical gold and silver, they vault it domestically or in secure international locations they control. That metal is effectively removed from the tradable supply, potentially for decades. Every ounce that exits the COMEX system is one less ounce backing the paper market, one less ounce available for industrial users, one less ounce that retail investors can potentially access at reasonable prices. The shrinking of available physical inventory creates a mathematical problem that only gets solved through higher prices, reduced industrial consumption, or both. So, what does all this mean for you, for someone who is watching this video trying to understand how to protect and grow wealth in an increasingly uncertain financial environment? It means the window for acquiring physical silver at current prices may be closing faster than most people realize. I'm not telling you this to create fear or urgency for the sake of it. I'm laying out the factual situation as it exists right now based on documented inventory movements and central bank actions. The strategy that wealthy institutions and sovereign nations are pursuing is physical accumulation of hard assets, particularly silver, while those assets are still available at prices that don't fully reflect the supply-demand fundamentals or the monetary instability risks. For retail investors, the practical question becomes how to act on this information. Physical silver comes in various forms: government-minted coins, privately minted rounds and bars, pre-65 U.S. silver coins, often called junk silver. Each has advantages and disadvantages in terms of premiums, liquidity, and recognition. Physical possession means you own the asset outright, but it requires secure storage and doesn't generate cash flow. Alternatively, there are silver ETFs and mining stocks, though these come with their own risks, including counterparty risk and the fact that you don't own physical metal directly. The key point is that education and action are both necessary. Understanding what's happening is step one. Developing a strategy that fits your financial situation and risk tolerance is step two. And implementation is step three. One of the most important lessons from this Sunday ambush scenario is about market structure and who has advantages in the financial system. Central banks and large institutions operate with information advantages, timing advantages, and scale advantages that retail investors simply don't have. They can execute multi-million ounce transactions over weekends. They can negotiate directly with mining companies for forward production. They can influence regulatory frameworks and market rules. Retail investors can't do any of that. But what retail investors can do is recognize patterns, understand incentives, and position accordingly. When you see central banks aggressively accumulating a physical asset, that's not noise, that's signal. You might not be able to move as fast or as large as they do, but you can move in the same direction. The $250 silver price target that's being discussed is just a random number someone pulled out of thin air. It's based on models that account for supply deficits, industrial demand growth, monetary debasement, and historical price relationships between silver and other assets. Could silver go higher than that? Absolutely. Could it take longer to get there than bulls expect? Also possible. Markets don't move in straight lines, and there will be volatility, pullbacks, and periods of consolidation. But the underlying fundamentals, declining inventories, rising industrial demand, monetary instability, and strategic accumulation by sophisticated players all point in one direction. The trend is your friend until it's not, and right now the trend in physical precious metals is decidedly bullish. There's a psychological element to all of this that's worth discussing. Most people have recency bias. They assume the future will look like the recent past. For the last decade, that meant stocks go up, bonds were safe, inflation was low, and precious metals were boring. That narrative has already started breaking down over the past few years, but many investors still haven't adjusted their mental models. They're still thinking in terms of the old playbook. Meanwhile, the players who understand monetary history and market cycles have already moved. They've already positioned for a different future, one where paper assets are less reliable and physical assets are more valuable. The Sunday ambush is just one visible example of positioning that has been happening quietly for months or years. As we move forward from this event, watching COMEX inventory levels becomes critical. If registered silver continues to decline, if delivery demands continue exceeding expectations, if premiums on physical metal over paper prices continue widening, those are all confirmations that the thesis is playing out. On the other hand, if we see large deposits back into COMEX vaults, if delivery demands fade, if premiums compress, that would suggest the situation is stabilizing. Right now, all indications point toward continued tightness, continued stress in the physical market, and continued upward pressure on prices. The broader investment lesson here extends beyond just silver. It's about understanding the difference between paper claims on assets and physical ownership. It's about recognizing when market structure creates vulnerabilities. It's about following the smart money, not the crowd. It's about thinking in decades, not days. Central banks operate with generational time horizons. They're not trying to flip silver for a quick profit next month. They're securing strategic resources that will hold value and provide optionality regardless of how specific policy decisions or market events unfold. That's the mindset that builds and preserves real wealth. So as you absorb what happened last Sunday, as you watch silver prices in the coming weeks and months, as you evaluate your own financial positioning, remember that we're living through a historic transition in the global monetary system. These transitions don't happen smoothly or predictably. They involve volatility, surprises, and rapid repricing of assets. The central banks who emptied those COMEX vaults before Monday's open understand this. They've studied the currency crises of the past, the hyperinflations, the debt defaults, the wars, and their aftermaths. They know that when trust in paper breaks down, people and nations flee to tangible value. And right now, quietly but deliberately, they're voting with their actions. They're taking physical metal off the table before everyone else realizes the game has changed. The question for you is simple. Are you going to wait until the repricing is obvious to everyone? Or are you going to act while the opportunity still exists? Because history suggests that by the time monetary crises become undeniable, the best assets have already been claimed by those who saw what was coming and moved first.